Anyway, sorry about that. We're a couple minutes late. We set up in a new room, which took a little extra time. But anyway, thank you for joining. I'm Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. We're going to talk about inflation, investing in a inflationary environment. So hopefully timely and interesting. But first, a couple of housekeeping items. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're in New Zealand, you can get a copy of our FAP at morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. All right, so let's just dive into this. So we're going to talk a little bit about inflation. But first, we're going to provide a little background. So I created this very strange slide, which is kind of like a little Pictionary puzzle, but want to talk a little bit about the world in general. And I actually wrote an ed note that will go out on Friday about this, or it'll be posted on the website Friday, go out on Saturday morning email. But I want to talk a little bit about the environment we've been in and potentially the environment we're going to, because it is very related to inflation. So since the end of the Cold War, we saw a huge acceleration, and kind of particularly starting this millennium, so after 2000, a huge acceleration in globalization and some other factors as well, but a lot of deflationary factors. And globalization, of course, is deflationary because a lot of originally manufacturing was put offshore, take advantage of cheaper labor. Then as technology increased, a lot of services were put offshore. So, right, whether that's call centers, up to the point where people overseas are now reading MRIs and things like that, a lot of back office operations from companies, a lot of this was offshore. A lot of that is deflationary, once again, because you're taking costs out. You're able to do things cheaper, and that's why companies are doing it. Then we had a bunch of other deflationary factors going on. So, number one, we had corporate taxes that were in general lowered. We saw erosion of collective bargaining, so basically unions getting weaker, which of course puts companies in control in terms of salaries, which is a big cost. And then of course we had interest rates going down. So if you look at kind of that 1989, 1990 period when the Berlin Wall fell, and kind of use that as a proxy for the end of the Cold War, interest rates in Australia were something like 17, 18%. In the US, they're just about 10%. And we've obviously seen this long-term interest rate drop, which of course, number one, obviously benefits companies because companies are able to borrow cheaper. But what it also does is, of course, it benefits governments. Governments were able to run bigger deficits while cutting taxes. That's deflationary. And yeah, lots of other factors, technology making things more efficient. So we had all these deflationary forces, which allowed us to do something that economists used to think wasn't possible. It allowed interest rates to be very low and stay very low. It allowed massive increases over time, and certainly at targeted times, of fiscal stimulus from governments. It allowed just the ability for central banks also just to inject a lot of liquidity and money into the economy and not get inflation. So what has changed recently? Well, a couple of things changed. So I have a picture of Trump up there just to talk about some of the forces that have come out against globalization. So I think he's a pretty good representative of that. But of course, we've seen that in a lot of different countries as well. We had COVID. So what did COVID do? Well, originally, a lot of this stuff was described as transitory. But I think what COVID did is it scared a lot of governments and people about where their supply chains were. And how do you get access to vaccines and medical equipment when it's all made in China or India or different countries? So I think that awakened a lot of people to the dangers of offshoring a lot of your manufacturing and having your supply chains very dependent on other countries. Companies woke up to this as well, and thought a lot about, okay, well, if I'm making something that is taking components from all over the world, and I'm relying on kind of just-in-time manufacturing where something arrives that day and I put it together and then ship it off somewhere else. What happens when there's bottlenecks, and a lot of the bottlenecks that were caused around COVID? So there has been a lot of rethinking of oh, sorry if there's an echo, Lisa. So there's been a lot of rethinking of these global supply chains, right? They provided this benefit. They provided this benefit that you could do things cheaper, but there are also problems with it. So COVID, and then finally, of course, we had the war in the Ukraine, the continuing war in the Ukraine, which once again, as the Cold War broke down a lot of these barriers and sort of and obviously like fostered in this golden age of globalization, we're now kind of retreating back into different camps again. So some of the stuff that we saw during the Cold War, particularly around the tensions with Russia and with China, again, we're sort of seeing some of these barriers come back up, and we're seeing ideology start to drive economic decisions. So a lot of stuff has happened. And the question is, are all these deflationary forces that we talked about going away? We're going back to this, and that's the Berlin Wall, of course. We're going back to a world where, once again, this break we had between low interest rates, lots and lots of monetary and fiscal stimulus, not leading to inflation. Have we gone back to a world that is more like what things were like in the 80s and before, where we had to be very careful about how we balance things like employment and interest rates and inflation? So just a thought to put out there if there is a big shift. And I wanted to put that context around this discussion around inflation, because, you know, what we're trying to figure out as investors, right, is, are we investing in an inflationary environment for another year, another 2 years until this is brought under control? Or is this something we're going to have to live with for a long time, where we're going to have these bouts of inflation that need to be balanced by central banks and government? So I think that's the question that's the question we're going into. All right, so let's talk about inflation. And let's talk about what's going on with inflation. So expectations, and one of the things, of course, about inflation is that how long it sticks around is not necessarily just based on interest rates and things like that, but it's also about expectations, right? So the expectations we all have for the future in regards to inflation have big impacts, right? So what do you do if you believe prices are going to keep going up? Well, you would buy stuff now. It makes natural sense that you would accelerate purchases as long as you could afford it if you believe prices are going up. If I go and tell you that, and you think you need a car in the next couple of years, and I go and tell you, well, cars next year are going to cost 25% more, and you had the money for it, you'd probably just buy the car now. It makes sense, right? So the expectations of inflation can, of course, accelerate purchases. The more we purchase things now, of course, the more inflation will go up. So it's a little bit of a self-fulfilling prophecy. The other thing, of course, is with employment. So if your expectation is that inflation will continue, and your expectation is your real or inflation adjusted standard of living is going to keep dropping, you are going to demand raises. Very simply. And so whether that demand is an overt demand where you go to your boss and say, I want a raise, whether it is in some sort of collective bargaining agreement where you're part of a union and they are going to force through higher increases going forward because of inflation expectations, or whether you just get a raise by saying, forget it, I'll just go get another job where they pay me more. Well, all of that, of course, is going to increase costs to businesses who will try to pass that on to consumers. And you get this thing that Philip Lowe was talking about earlier in the year, this wage price spiral. Wages go up, prices go up. You demand higher wages, prices go up again. So that's really, the question about inflation. And we've certainly seen inflation expectations go up, which you see in this graph. And we've certainly seen that we are finally getting wage growth, which is a good thing if it's your wage that's going up. Not such a good thing from an overall economic standpoint if that's going to drive further inflation. All right, so let's go back and let's look at a couple different stats from the last big period of inflation we had. Now, we're looking at the US, but this was a global phenomenon, and it was really during the 70s. So if we go back and look at what happened during the 70s, now we're taking a couple different figures here. Number one, we have the S&P 500, 500 largest shares in the US. We have US CPI, but this once again was mirrored around the world. So CPI, Consumer Price Index, that is how much a typical basket of consumer goods increased every year. And then we have real earnings. So real earnings refers to inflation adjusted earnings on the S&P 500. So these are not earnings for people, these are earnings from the companies that make up the S&P 500. So what do we see during this inflationary time? Well, a couple things. Number one, over this decade, stock market didn't do too well, right? So actually slightly negative in terms of a return, but certainly not what you're looking for over the course of a decade. The other thing that we saw is very low earnings growth, right? So at the end of the day, we saw earnings growth over a decade of less than 5%. Also, not what you want to see as an investor. You want companies' earnings to grow. So what happened and what do we see in this if we go and look at this chart? Well, as inflation started to take off, what we saw initially is that prices were able to be passed on, right? So particularly between 73 and 74, we saw these increases being passed on. And if we think about this, this makes sense. Right? So before inflation is ingrained in everybody's mind, maybe you don't really notice. So maybe all of a sudden, in the different ways that prices are increased, that, either it's shrinkage, so your package of chips is getting smaller but costs the same, or it's actually increases. Consumers don't really notice at once, but then all of a sudden, it's in every newspaper, it's being talked about on television that there is inflation, and then people start to notice. And that's when we start to get changes in consumer behavior. So you'll see as inflation continued to be high, all of a sudden, real earnings. So what does this mean? It means one of two things. Companies are either losing revenue, and we'll talk about the impact that happens during inflation. Companies are either losing revenue or consumers, and same difference, or consumers are not willing to pay more and companies actually have to cut prices to maintain that market share. And what we'll see is inflation it gets lower and then starts going up again. And we see the same thing, the same impact in the late 70s and 90s, where initially we had some earnings increase, and then they went away over time. So one of the points about this is as inflation becomes ingrained within an economy, we start to see all sorts of bad things and all sorts of bad things that investors need to worry about. And we'll talk a little bit about what that is, but just remember that, we likely have not really seen the impact of inflation so far on companies. Of course, I've been talking about it. We haven't seen the bad impact of inflation so far. And I'll talk about how we're starting to see those signs, but something to think about. And this is just what I was saying before. So in aggregate, as inflation persists, it's harder to pass along prices to consumers. And we want that, not as consumers, but we want that as investors. And of course, the other thing we need to worry about is real returns as investors. So during this very long period after the Cold War, where we saw very low inflation, that made our real returns actually increase. So if you look at nominal returns, so nominal returns are just literally how much did the S&P 500, how much did the ASX 200 go up? Nominal returns weren't all that different from what they were historically, if we kind of look at the end of that Cold War period. But because inflation was so low, those real returns, which is what you care about as an investor, they were actually quite high, and they actually went up basically just from that drop in inflation. So we need to think about everything in terms of real returns. All right, so let's think about companies now and how inflation impacts companies. So let's look at revenue. So revenue, of course, is what they sell. Goods and services, volume times price. So what happens? Well, consumer behavior changes in inflationary time periods, right? So once again, it probably takes a little while. It's probably taken even longer for us right now because there's a lot of excess savings built up during COVID, but our behavior as consumers will change. So a couple different things can happen. Number one, you can sit there and prioritize your spending more. So, okay, I am not going to do this because this is important to me. Well, that's not great for the company that sells you the first thing, right? You are going to change your behavior by trying to reduce your spending. So maybe you don't need that car. Maybe you don't need to go buy new furniture. Your old furniture can last longer. So everyone delays things. So once again, bad for companies because it's impacting what they're able to sell. You could also sit there and say, okay, I'm going to cut back on quality. So instead of buying some premium product, I'm going to cut back and buy something cheaper. Also not great for companies, right? They generally make more money on those premium products. So there's all sorts of different things that happen on the revenue side. And this is an issue for companies because, of course, all their demand forecasting with everything else that's going on, they're trying to, and we've seen this with inventory issues, right? We've seen this where there's been these huge inventory issue buildups because all of this demand forecasting that companies were doing is wrong as behavior actually changes. So not great for companies. And so what they're out there doing now is they're fighting for market share. And fighting for market share is very difficult because one way that often you fight for market share is you cut prices. Well, that's a problem because cutting prices in an inflationary environment isn't great because all of your costs are going up. So you're going to have to pay people more, right? That wage price spiral, well, the wage part, that's a big cost for companies. You're going to have to pay more for inputs into whatever you're producing, whatever good and service you're producing. So whether that's raw materials, if you're manufacturing somebody, or really the input is wages for companies as well. And of course, anything else you need to source, whether it's real estate, anything else that's on these CPI escalators, it's all going to cost more. Leasing office is going to cost more. So your costs are going up. So that's a problem as well. And of course, the bottom line is, from a profitability standpoint, what you need to do in order to remain just as profitable, so you need to pass all these costs on to consumers without having your revenue change, which is really hard. To raise prices without affecting how much you sell is very, very difficult. So this is the issue that companies are running into. All right, so we've got a couple of questions. Okay, so Lisa says, is the inflation we're seeing now simply a catch-up from a long period of very low interest rates, or is it more because of the factors shown in slide 1? So my argument, and this is not a unique argument, of course, my argument would be what we're seeing is basically we all got lulled into during this sort of post-Cold War period. We all got lulled into this notion that no matter what was done, we would not see inflation. So central banks got lulled into this and they said, okay, well, COVID's hitting. We need to cut interest rates dramatically. So they did. We need to inject a bunch of money into the economy. So they did. And the expectation was that there would be no inflation. At the same time, we had governments doing the same thing, right? So whether we look at Australia, whether it's JobKeeper, JobSeeker, all these programs that are just injecting money into the economy with very good intentions, right? Obviously protecting the economy from what was going on with COVID. So as all of that money gets pushed in, we didn't think there'd be any inflation because we did the same thing during the GFC. There was no inflation. So the expectation was, I think, by governments, by people, by central banks, was that there wouldn't be any inflation. So I wouldn't call it catching up. What I'd say is that enough of those deflationary factors changed that we were getting a different reaction for doing the same thing, right? So that's kind of my argument. And so what I think this will mean is that we will have to settle into a different equilibrium, right? So that interest rates, and I know people are very focused on interest rates, as they should be, but we're not going to be able to have interest rates at 0.10% anymore, right? Without a problem. So whether our interest rate range increases to higher levels that are more like historic averages, or maybe we're bouncing up and down around that 4% range, that's just a very different environment. And, I think there's a lot of people out there and a lot of governments and a lot of companies that are going to have a very difficult time operating in a 4% interest rate world, because people are so used to interest rates being that low. And I think, frankly, the debt balances that a lot of individuals, companies, and countries have taken on probably doesn't work so well at 4%, right? If we have, a Fed funds rate of 4%, if the RBA raises the cash rate to 4%, I think there's going to be a lot of problems. And so I think the question is, like, what is that equilibrium and how messy is it to try to get there? So Eric's got a question. Do you have this chart over these years that provides interest rates? I do. If you could send me an email, Eric, I can find that for you. Yeah, significant cost on gearing is the cost of debt, exactly, which obviously increases, right? So that's another deflationary thing that we saw when we saw interest rates going down. And then, kind of last thing that I guess I'd say that I think is happening and is potentially underappreciated, like another inflationary effect that we have is all the efforts around decarbonization, right? And so whether that is companies paying that, whether that's individuals paying that through higher power bills, that's going to be a huge cost also. And of course, that can be inflationary, right? So that's another big increase in spending. So something to think about. All right. So what do we do about this? Well, as investors, and we'll talk about some different asset classes in a bit, but what conceptually do we need to think about in this environment right here, right? Where we've got these problems, our costs are going up, we're trying to maintain the same sales and pass along those costs. So who's able to do that? Well, companies that have sustainable competitive advantages should be able to do that. And what a sustainable competitive advantage is, of course, or a moat, what that is that is some attribute about that company that is protecting the company from the market forces inherent in capitalism that cause people to compete by lowering prices, cause people to compete by investing more and building better goods and services. So very simply, if you do have a moat, you should be able to pass on those price increases. And you should be able to do that. Obviously, there's lots of different types of moats and types of companies out there. And I can go through some examples, but you should be able to do that. And yeah, I don't know, a couple of examples we could go through that are sort of top of mind. If you have a very powerful brand, and that brand is something that means people are going to be drawn to you no matter what, even if you do increase prices, then that is a moat. That's an opportunity for you to pass on those costs to consumers because they're still going to buy your brand because it's so powerful. If we look at banks, for example, they're an interesting one. They have a moat that's generally related to switching costs. The fact that it's a pain to switch banks, so people don't do it. And we're seeing that right now, right? So look at the big four and look at what they have done with interest rate increases, right? They instantaneously increase the interest rates. And this is publicized and everyone knows about it, right? It's in all the papers. Instantaneously increase the interest rates on loans that they have. And then very slowly, if at all, increase the interest rates on deposits. This is not secret. Everybody knows it. There are a lot of people, whether that's politicians or individuals, complaining about it. But why can the banks do this? Well, they can do it. They do it because they know there's a lot of inertia involved in switching your bank because it's a giant pain. So even though you can go to other banks and get higher interest rates, nobody's doing it. Some people are doing it, obviously, but a lot of people don't do it because they don't want to go through the hassle of switching all the tentacles and getting rid of all the tentacles that the bank has in you, whether it's all your friends set up on BPay, all your bill pays automatically set up, your direct deposit from your paycheck, all the different products you have with the bank and how easy it is to, shift money around if everything's within that ecosystem. A lot of people don't want to do it. So, that's an example. Other examples of moats are, of course, if you have some sort of government license. All right. So if you're Transurban and you have automatic CPI escalators in the tolls, and you are the only person that owns this toll concession for 99 years, well, once again, you can do that, right? You can pass on those costs. So a lot of different moat examples, but it's a good thing to explore in an inflationary time, explore that competitive environment and see if the companies that you own, if you think they have advantages. And these are those 5 sources of moats. I'm not going to go through them all because I just talked about them, but these are really the 5 different sources that Morningstar identifies as moats. So think about companies that you own, which one of these moat sources may or may not apply to them, and if this is going to have a big advantage during an inflationary time. Okay. Let's talk about asset classes, because I think that this is what everyone's interested in. And we'll go back and we'll look at types of asset classes that typically perform well in inflationary times. So we want to think about that competitive environment, obviously, for companies that we own, but we also want to think about, okay, are there certain places we can potentially put our money that would do better in an inflationary environment? All right, so let's talk about, at a high level asset class, shares, bonds, and cash. Now, let's think about this intuitively, what they are. Shares should perform better in an inflationary environment. Why? Because they do have the ability. Now, whether they can or not, we need to assess, but they do have the ability to actually raise prices. And at the very least, hopefully recoup some of that inflation, right? You don't get that if you own a long-term bond, right? If you're in a long-term fixed rate bond, your payment, the coupon payment, is not changing. There's a couple exceptions around inflation protected bonds, but your coupon payment's not changing. So if you've locked yourself in to a long-term bond, well, this is a problem for you, right? Because if inflation's going up 5% a year, in real terms, that coupon payment is worth 5% a year less every single year you get it, and you're locked into it. So not great. Same thing for cash, right? Go out there, look at whatever interest rate you are getting for cash right now. I guarantee it's less than the 7% that inflation is in Australia. So you are losing money. So in real terms, in terms of purchasing power, you are losing money by having cash. Doesn't mean that there aren't reasons to have cash, but what it does mean is that you're not going to park, or you shouldn't park, a lot of money in cash or fixed interest in these environments. A couple of things that perform very well are listed property that traditionally have performed well, and infrastructure. So there's a couple different reasons for that. So both of them generally have inflation escalators built into their contracts. Now, go and check, obviously, look at the individual circumstance that you're looking for, but in general, because these are huge fixed cost projects that have to be paid for in advance, generally have to borrow a lot of money to do it, they generally have contracts where you do have those CPI escalators in there. So that protects you, right? So if you are Lend-Lease, or I think owns this building, if you're a Lend-Lease and you signed a lease agreement, or Morningstar signed a lease agreement with you, and there's automatic inflation increases to rent, well, okay, so that's a good thing for you. That protects you a little bit. The other thing is inflation in general is going to hit the main inputs into building a new building, for example, right? So it's going to hit labor because it takes a lot of labor, so wages will go up, and it's going to hit materials, right? So all the basic materials, all the stuff you need to buy to build a building. So what does that mean? Well, it means if something's more costly to produce and you already own that something, that thing's going to go up in value, right? So it's construction slows down, previously built buildings are worth more. So that's something. And then, of course, speaking of things, inputs that go into things, let's start talking about commodities. So Vanguard went back and they did a study, and we're doing a lot of these studies, obviously. We're doing them back in kind of that 70s to 80 period. So just keep that in mind. Obviously, things can change. So that's where we're getting a lot of our data, because that was the previous high inflation environment. So they showed that commodities rose by 7 to 9% for every 1% of unexpected inflation. Right? So unexpected inflation, for example, and whether that commodity is the thing driving inflation or whether it's a result of inflation, it's a chicken and egg thing, right? But those materials, those raw materials that are going into us building everything, so whether that's oil, whether that's iron ore, things like that of that nature generally are going up. And remember, unexpected inflation is going in this year. I don't think many people had the expectation that inflation would be this high. And of course, that has been the surprise. Now, if it gets ingrained in us that inflation 7% a year every year, and it continues on 7%, you're probably not going to see that big kick up. But commodities also have typically done well in inflationary environments. So Lisa says, if inflation returns to lower levels in the future, will long-term bonds go up in price compared to what they are now? My guess would be yes. So if we just sort of go through, kind of this scenario, right? So let's say inflation dramatically drops. And at this point, I'd say if it really started dropping, that would probably be unexpected. Although, it's hard to tell exactly what people are thinking. So I think if inflation drops and interest rates stop going up and potentially are cut, if they're cut, then of course those long-term yields, those long-term bonds will go up in price. So I think that's really, the big driver, right? That we're talking about inflation, but there's a relationship between inflation and interest rates. And so as interest rates keep going up, bond prices go down. If that was to reverse itself, and frankly, if it was even to pause, if we even got to a point, we've been talking about this pivot point for a long time, but if we even get to a point where they stop going up and the expectation is that interest rates will stop going up, I would suspect that those bonds would do very well. And they certainly mathematically would do well as interest rates came down. Oh, look at that. We got through the entire deck. Well, that's exciting for me and probably exciting for all of you as well. So let me know if you have any other questions. And then, if anyone's interested in reading this editor's note that comes out on, that'll be posted on our website tomorrow. Give it a read. My email's in there. You can email me and let me know what you think. And I think we will just call it a day. So go out there and buy stuff very quickly before, inflation goes up. Anyway, hope everyone has a great Thursday and a great weekend. If anyone's in Sydney on Saturday at the ASX Investor Conference, come by and see us at the Morningstar booth. All right. Thank you, guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.